Question 1. Legal and regulatory framework. What is the primary responsibility of an insurance company in New Jersey regarding its reinsurance contracts under state law? A. To ensure that all reinsurance contracts are filed with the State Department of Insurance within 30 days of execution. B. To maintain an appropriate reinsurance program in place that is reviewed by external auditors annually. C. To disclose all reinsurance agreements on a quarterly basis to the State Department of Insurance for compliance. D. To ensure that the reinsurer is licensed in New Jersey or approved by the New Department of Insurance. Answer D. To ensure that the reinsurer is licensed in New Jersey or approved by the New Jersey Department of Insurance. Explanation. In New Jersey, reinsurance companies must be licensed or approved by the State Department of Banking and Insurance. According to New Jersey's regulations, the insurer must ensure that the reinsurer meets all necessary licensing or approval criteria before engaging in any reinsurance agreement, critical to ensure that the reinsurance arrangement complies with state laws and that the financial obligations between the parties are enforceable under New Jersey's regulatory framework. Answer is incorrect because there is no specific 30-day requirement for filing contracts, but general rule for timely reporting exists. Answer B is not correct, as while annual reviews might be required for internal practices, state reporting does not mandate an external audit solely for reinsurance. Answer C is incorrect because quarterly disclosures are generally required for financial information, not specifically for reinsurance agreements. Question 2. Reinsurance contract structure. Which of the following accurately distinguishes treaty reinsurance from facultative reinsurance? A. Treaty reinsurance is purchased for specific risks on a case-by-case basis, while facultative reinsurance covers a portfolio of risks automatically. B. Treaty reinsurance automatically covers a portfolio of risks, while facultative reinsurance is negotiated on a risk-by-risk basis. C. Facultative reinsurance requires no formal contract, while treaty reinsurance requires a formal agreement. D. Reinsurance involves the transfer of risks to a single reinsurer, whereas treaty reinsurance spreads risks across multiple reinsurers. Answer B. Treaty reinsurance automatically covers a portfolio of risks, while facultative reinsurance is negotiated on a risk-by-risk basis. Explanation. Treaty reinsurance is a form of reinsurance where the reinsurance agreement automatically applies to a broad category or portfolio of risks as defined in the treaty agreement, usually covering a range of policies or classes of business over a specified period. Reinsurance, on the other hand, is negotiated on a case-by-case basis, typically when an insurer wants to transfer the risk of an individual policy or a specific exposure to the reinsurer. Answer is incorrect because it reverses the characteristics of treaty and facultative reinsurance. Answer C is incorrect as both types of reinsurance require formal agreements. The main difference lies in the scope of coverage, portfolio versus individual risk. Answer D is also incorrect as treaty reinsurance typically involves a single reinsurer taking on the whole risk, but it does not automatically spread risk across multiple reinsurers unless specified in the treaty agreement. Question 3. Scenario-based question on claims management. Mr. Williams, an insurance company manager in New Jersey, has encountered a situation where a large claim from a policyholder is partially covered under the company's reinsurance agreement. However, the reinsurer has disputed some parts of the claim and delayed its response, leading to a conflict. What should Mr. Williams do to address the situation according to New Jersey regulations? A. Submit the claim to the New Jersey Department of Insurance for immediate arbitration. B. Initiate the dispute resolution process as per the terms outlined in the reinsurance agreement. C. Withhold further payment to the policyholder until the reinsurer responds. D. Seek a court order for the reinsurer to pay the disputed claim immediately. Answer B. Initiate the dispute resolution process as per the terms outlined in the reinsurance agreement. Explanation. In situations of claim disputes between an insurer and a reinsurer, the first course of action is to follow the dispute resolution procedure stipulated in the reinsurance contract. Reinsurance agreements typically outline a clear process for resolving conflicts, including mediation or arbitration, and this should be to avoid legal action. Answer is incorrect because while state intervention might be required in some cases, arbitration should first follow the reinsurance contract's provisions, not be escalated directly to the state. Answer C is incorrect because withholding payment to the policyholder is generally not advisable unless the reinsurer has formally refused coverage, and such actions must be handled according to legal and contractual obligations. Answer D is not correct since seeking court orders should only be last resort when all contractual and regulatory avenues for dispute resolution have been exhausted. Question 4. Underwriting and pricing. Which of the following factors is the most important consideration when setting the premium rates for a reinsurance treaty? A. The historical claims data of the ceding insurer. B. The regulatory requirements imposed by the New Jersey Department of Insurance. C. The credit rating of the reinsurer. D. The market competition and prevailing pricing trends in the reinsurance industry. Answer A. The historical claims data of the ceding insurer. Explanation. When setting premium rates for a reinsurance treaty, the most important factor is the historical claims data of the ceding insurer. This data reflects the insurer's loss experience, which helps the reinsurer assess the risk and determine an appropriate premium to cover potential future claims. Answer B is incorrect because while regulatory requirements are important, they typically don't directly dictate the premium rate. Rather, they ensure that the reinsurer meets solvency and reporting standards. Answer C, while relevant to the financial stability of the reinsurer, is not a direct factor in pricing. Answer D reflects market trends, but pricing should primarily consider the risk data from the ceding insurer. Question 5. Risk management. What is the primary purpose of the excessive loss reinsurance arrangement? A. To provide full coverage for all claims arising from a policyholder's losses. B. To limit the amount ceding insurer must pay on claim beyond certain threshold. C. To allow reinsurers to share equally in all claims with the ceding insurer. D. To cover claims under specific group of policies automatically without underwriting. Answer B. To limit the amount a ceding insurer must pay on a claim beyond a certain threshold. Explanation. The excessive loss reinsurance arrangement is designed to protect the ceding insurer by limiting its exposure to large losses. Under this arrangement, the reinsurer covers the portion of the loss that exceeds the predetermined threshold, ensuring that the ceding insurer's liability is capped. Answer is incorrect because the excessive loss reinsurance does not provide full coverage, only coverage above a certain threshold. Answer C is incorrect as this describes a quota share arrangement, not excessive loss. Answer D is not correct because excessive loss reinsurance is not automatic and requires underwriting to assess the risk and set the threshold. Question 6. Emerging trends. How has the introduction of big data and analytics impacted the reinsurance industry? A. It has led to the elimination of underwriting altogether, with reinsurers using data alone to assess risk. B. It has allowed for more accurate risk modeling, improving pricing, and the assessment of large, complex risks. C. It has reduced the need for reinsurers to form long-term contracts with ceding insurers. D. It has simplified reinsurance documentation, requiring fewer contractual terms and conditions. Answer B. It has allowed for more accurate risk modeling, improving pricing, and the assessment of large, complex risks. Explanation. Big data and analytics have had a transformative impact on the reinsurance industry by enabling reinsurers to develop more sophisticated risk models, improving the accuracy of pricing and allowing for better assessment of large or complex risks. By analyzing vast amounts of data, reinsurers can effectively predict potential losses and set appropriate premiums. Answer is incorrect because underwriting is still essential even with the use of data to understand the full scope of the risks involved. Answer C is incorrect as long-term contracts remain a common practice in reinsurance, especially for treaty agreements. Answer D is not accurate as big data doesn't reduce the need for comprehensive contractual terms in reinsurance agreements. Question 7. Claims management. Under New Jersey law, which of the following would typically be grounds for a reinsurer to deny a claim under a reinsurance treaty? A. The claim was filed too soon after the loss occurred, violating the ceding insurer's notification policy. B. The ceding insurer failed to obtain the reinsurer's prior approval for settlement as required by the treaty. C. The reinsurer's rating is dropped below the minimum required level for solvency. D. The ceding insurer did not fully disclose the financial health of the policyholder involved in the claim. Answer B. The ceding insurer failed to obtain the reinsurer's prior approval for settlement as required by the treaty. Explanation. Reinsurers often include a provision in the reinsurance treaty that requires the ceding insurer to obtain prior approval for settlements involving large claims. Failure to obtain such approval can result in a reinsurer denying the claim or reducing its liability. Answer is incorrect because the timing of filing, while important, is usually covered by internal procedures rather than a specific ground for denial under New Jersey law. Answer C is incorrect because the solvency of the reinsurer is a broader regulatory issue that would not typically result in a claim denial, but may affect the reinsurer's ability to meet future obligations. Answer D is incorrect because the financial health of the policyholder is generally not a direct issue unless explicitly covered by the treaty. Question 8. Reinsurance basics. Which of the following best describes a facultative reinsurance arrangement? A. The reinsurance automatically covers all risks under an insurance policy, regardless of the individual risks. B. The insurer purchases reinsurance for a specific, individually selected policy or risk. C. The reinsurer accepts an entire portfolio of risks under a long-term agreement. D. The reinsurance agreement applies only to policies that exceed a certain loss threshold. Answer B. The insurer purchases reinsurance for a specific, individually selected policy or risk. Explanation. Facultative reinsurance is a type of reinsurance where the ceding insurer purchases reinsurance for a specific, individually selected risk or policy. Unlike treaty reinsurance, which covers a broad portfolio of risks, automatically facultative reinsurance is negotiated on a case-by-case basis. Answer is incorrect because it describes treaty reinsurance, not facultative. Answer C describes treaty reinsurance where the reinsurer accepts a portfolio of risks, not a specific individual risk. Answer D is a characteristic of excessive loss reinsurance, not facultative. Question 9. Financial aspects. When considering the financial stability of a reinsurer, which of the following metrics is most commonly used to assess solvency? A. The reinsurer's claims paying ability and operating profit margin. B. The reinsurer's total premiums written in the last year. C. The reinsurer's ratio of reserves to total assets. D. The reinsurer's credit rating from independent rating agencies. Answer D. The reinsurer's credit rating from independent rating agencies. Explanation. The most commonly used metric to assess the financial stability and solvency of a reinsurer is its credit rating from independent rating agencies such as AM Best or Standard and Poor's. These agencies evaluate the reinsurer's ability to meet its financial obligations, including claims payments. Answer A, while important, is less comprehensive than a credit rating for assessing solvency. Answer B is not as relevant to solvency as it reflects business volume rather than financial health. Answer C, the ratio of reserves to assets, is useful but not as common as credit ratings for solvency evaluation. Question 10. Risk management. Which of the following strategies would be most effective in mitigating the risk of large catastrophic claims for an insurer in New Jersey? A. Purchasing facultative reinsurance for individual high-risk policies. B. Implementing strict underwriting guidelines to avoid taking on high-risk policies. C. Using retrocession to transfer risks from one reinsurer to another. D. Maintaining a high level of surplus capital to absorb unexpected claims. Answer C. Using retrocession to transfer risks from one reinsurer to another. Explanation. Retrocession is the practice of transferring risk from one reinsurer to another, which can help mitigate the risk of large catastrophic claims. By spreading risk among multiple parties, an insurer can reduce its exposure to significant losses. Answer A. While facultative reinsurance can help with individual risks, does not fully address large-scale catastrophic events. Answer B focuses on prevention but may not be sufficient for mitigating large losses once policies are written. Answer D, while maintaining surplus capital is important for solvency, does not reduce the overall risk exposure from catastrophic events. Question 11. Legal and regulatory framework. Which of the following is not a responsibility of a reinsurer under New Jersey's reinsurance regulations? A. Complying with the ceding insurer's terms and conditions in reinsurance treaties. B. Ensuring that all reinsurance transactions are reported to the New Jersey Department of Insurance. C. Guaranteeing that the ceding insurer maintains a certain level of capital. D. Providing the ceding insurer with accurate financial statements upon request. Answer C. Guaranteeing that the ceding insurer maintains a certain level of capital. Explanation. Reinsurers are required to comply with terms in reinsurance treaties, report transactions to the regulatory authorities, and provide financial transparency to the ceding insurer. However, guaranteeing the ceding insurer's capital level is not a responsibility of the reinsurer under New Jersey regulations. This is a responsibility of the ceding, and failure to maintain adequate capital would lead to regulatory scrutiny, but the reinsurer is not liable for this. Question 12. Claims management. Under a treaty reinsurance arrangement, which of the following best describes the reinsurer's obligations regarding claims settlement? A. The reinsurer must settle claims directly with policyholders. B. The reinsurer must ensure the ceding insurer adheres to their internal claims settlement procedures. C. The reinsurer has the right to participate in the claims adjustment process, but the ceding insurer remains responsible for the settlement. D. The reinsurer must pay the ceding insurer immediately upon claim notice, regardless of settlement details. Answer. C. The reinsurer has the right to participate in the claims adjustment process, but the ceding insurer remains responsible for the settlement. Explanation. Under a treaty reinsurance arrangement, the reinsurer typically has the right to participate in the claims process, especially for large or complex claims. However, the primary responsibility for the settlement of claims rests with the ceding insurer. The reinsurer's role is usually to review and ensure the ceding insurer is handling them appropriately, rather than directly handling the settlement or paying the policyholder. Question 13. Reinsurance contract structure. Which of the following is most likely to be included in a reinsurance treaty but not in a facultative reinsurance agreement? A. Terms and conditions for covering individual risks. B. A blanket coverage clause for a portfolio of risks. C. A provision for selecting specific policies on a case-by-case basis. D. A requirement for the ceding insurer to obtain prior approval for each individual claim. Answer. B. A blanket coverage clause for a portfolio of risks. Explanation. A treaty reinsurance agreement typically covers a broad portfolio of risks or policies, and it often includes a blanket coverage clause. This clause automatically applies to all eligible risks within the portfolio without the need for individual selection. In contrast, facultative reinsurance covers specific, individually selected risks, so it would not include a blanket coverage clause. Question 14. Financial aspects. Which of the following would be considered a key consideration when determining the reserves needed by a reinsurer? A. The reinsurer's historical profitability. B. The reinsurer's credit rating from rating agencies. C. The anticipated future claims based on actuarial analysis. D. The regulatory solvency margin of the ceding insurer. Answer. C. The anticipated future claims based on actuarial analysis. Explanation. Reserves are set aside by reinsurers to ensure they can pay for future claims. These reserves are typically calculated based on actuarial analysis of anticipated claims. This analysis considers various factors such as claims frequency, severity, and potential large loss scenarios. While profitability A and credit rating B may impact reinsurers' financial health, they are not directly related to reserve requirements. The solvency margin of the ceding insurer D does not directly influence the reinsurer's reserve requirements. Question 15. Underwriting and pricing. Which of the following is a primary factor in determining the price of a reinsurance contract? A. The ceding insurer's claim frequency in specific geographical region. B. The current market conditions and competition within the reinsurance industry. C. The reinsurer's marketing strategy and brand strength. D. The reinsurance agreement's minimum retention requirement. Answer. B. The current market conditions and competition within the reinsurance industry. Explanation. Pricing in reinsurance contracts is often influenced by market conditions, including the availability of reinsurance capacity and competition among reinsurers. In a soft market with abundant capacity, pricing tends to be lower. In a hard market with limited capacity, pricing is generally higher, while the ceding insurer's claim frequency A and retention requirements D can impact pricing. The overall market dynamics B play a crucial role in determining the price. Question 16. Risk management. What is the primary purpose of a stop-loss reinsurance arrangement? A. To limit the ceding insurer's total liability on a per-policy basis. B. To limit the ceding insurer's total claims payments for a specific period. C. To provide the ceding insurer with a percentage of profits from underwriting. D. To allow the reinsurer to participate in the ceding insurer's investment portfolio. Answer B. To limit the ceding insurer's total claims payments for a specific period. Explanation. A stop-loss reinsurance arrangement is designed to limit the ceding insurer's total claims payments for specific period, typically year. Once the ceding insurer's total losses exceed certain threshold, the reinsurer covers the additional losses. This provides financial protection against unusually high claim years. Answer describes excessive loss reinsurance, not stop-loss. Answer C is unrelated to stop-loss reinsurance, and answer D involves an entirely different financial arrangement. Question 17. Reinsurance basics. Which of the following best describes a quota-share reinsurance? A. A reinsurance arrangement where the reinsurer shares in the underwriting risk of all policies in proportion to the ceding insurer's retention. B. Reinsurance arrangement where the reinsurer takes on specific high-value risk from single policy. C. Reinsurance arrangement where the reinsurer covers losses above certain threshold on all policies in the treaty. D. Reinsurance arrangement where the reinsurer only provides coverage for specific geographic areas. Answer A. A reinsurance arrangement where the reinsurer shares in the underwriting risk of all policies in proportion to the ceding insurer's retention. Explanation. In quota-share reinsurance arrangement, the reinsurer assumes fixed percentage of all policies written by the ceding insurer. This agreement spreads the underwriting risk in proportion to the ceding insurer's retention, making it form of proportional reinsurance. Answer B describes facultative reinsurance, while C describes excessive loss reinsurance, and D refers to geographic limitation that is uncommon in reinsurance arrangements. Question 18. Case studies and practical applications. Scenario. Mr. Daniels, a ceding insurer, has a large portfolio of commercial property policies. He is concerned about the impact of potential natural disasters and wants to limit his exposure. What type of reinsurance arrangement would be most appropriate for Mr. Daniels? A. Excessive loss reinsurance. B. Quota-share reinsurance. C. Facultative reinsurance. D. Retrocession. Answer A. Excessive loss reinsurance. Explanation. In this scenario, Mr. Daniels is looking to limit his exposure to large losses, such as those from natural disasters. Excessive loss reinsurance would be the most appropriate because it provides coverage for losses above a certain threshold, thereby protecting the ceding insurer from catastrophic events. Quota-share B would involve sharing a percentage of all risks, but would not limit exposure to losses in the same way. Facultative reinsurance C is typically used for individual risks, while retrocession D refers to the transfer of risk between reinsurers, not between insurers and reinsurers. Question 19. Legal and regulatory framework. What must a reinsurer do under New Jersey's regulations before entering into a reinsurance contract with a ceding insurer? A. Submit a copy of the reinsurance treaty to the New Jersey Department of Insurance. B. Obtain the ceding insurer's approval of the treaty terms. C. Ensure that the reinsurance contract complies with the New Jersey Insurance Code and applicable laws. D. Disclose all financial details to the policyholders affected by the reinsurance arrangement. Answer C. Ensure that the reinsurance contract complies with the New Jersey Insurance Code and applicable laws. Explanation. Under New Jersey regulations, before entering into a reinsurance contract, the reinsurer must ensure that the contract complies with the New Jersey Insurance Code and all applicable laws. This ensures that the reinsurance arrangement is legally sound and does not violate regulatory requirements. Answer is incorrect because submission to the Department of Insurance is not required unless there are exceptional circumstances. Answer B is not required by New Jersey law as the ceding insurer does not need to approve the reinsurer's terms. Answer D is incorrect as policyholder disclosure is not typically required for reinsurance arrangements. Question 20. Claims management. Which of the following is a key component of claims audit and evaluation in reinsurance? A. Ensuring the ceding insurer follows its underwriting guidelines. B. Verifying that the reinsurer's financial reserves are sufficient to cover potential claims. C. Reviewing claims settlement practices to ensure they align with treaty terms and conditions. D. Establishing dispute resolution process for claims under facultative reinsurance. Answer C. Reviewing claims settlement practices to ensure they align with treaty terms and conditions. Explanation. A key component of claims audit and evaluation is reviewing the ceding insurer's claims settlement practices to ensure that they align with the terms and conditions specified in the reinsurance treaty. This ensures that the reinsurer is not liable for claims outside the scope of the agreement or those improperly handled. Answer is related to underwriting, not claims settlement. Answer B, while important for solvency, is not part of claims audit specifically. Answer D refers to dispute resolution, which is important but not part of the standard claims evaluation process. Question 21. Reinsurance basics. Which of the following best describes retention in reinsurance? A. The amount of risk a reinsurer assumes in a treaty reinsurance agreement. B. The amount of risk that the ceding insurer retains before reinsurance coverage kicks in. C. The amount of capital a reinsurer is required to maintain by regulatory authorities. D. The profit margin that the reinsurer aims to achieve on reinsurance contracts. Answer B. The amount of risk that the ceding insurer retains before reinsurance coverage kicks in. Explanation. Retention refers to the amount of risk that the ceding insurer retains before reinsurance coverage begins. This amount is often specified in the reinsurance contract and is typically a percentage of the policyholder's losses. Answer A refers to the risk assumed by the reinsurer, not the ceding insurer. Answer C is unrelated to the concept of retention, as retention focuses on the ceding insurer's liability. Answer D refers to profitability but does not describe retention. Question 22. Underwriting and pricing. Which of the following is most likely to influence the pricing of reinsurance contracts? A. The claims history of the ceding insurer's policyholders. B. The reinsurer's profit margins from previous years. C. The overall risk exposure of the ceding insurer's portfolio. D. The reinsurer's investment performance. Answer C. The overall risk exposure of the ceding insurer's portfolio. Explanation. The pricing of reinsurance contracts is largely influenced by the overall risk exposure of the ceding insurer's portfolio. Reinsurers assess the types and volume of risks that the ceding insurer is taking on and price the contract accordingly. Claims history A can influence pricing, but it is just one factor among many. Profit margins B. Investment performance D are internal financial considerations that do not directly determine pricing for specific reinsurance agreement. Question 23. Legal and regulatory framework. Under New Jersey reinsurance regulations, which of the following is required for a reinsurer to do business in the state? A. Maintain a branch office within New Jersey. B. Submit an annual report to the New Jersey Department of Insurance. C. Register with the New Jersey Secretary of State. D. Have a specific quota of reinsurance premiums written in the state. Answer B. Submit an annual report to the New Jersey Department of Insurance. Explanation. Reinsurers doing business in New Jersey are required to submit annual reports to the New Jersey Department of Insurance, ensuring transparency and compliance with state regulations. Maintaining a branch office A or a specific premium quota D is not a requirement, and registration with the Secretary of State C applies generally to businesses, is not specific to reinsurers. Question 24. Claims management. Which of the following would be the main role of the claims manager in a reinsurance company? A. To decide the appropriate reinsurance treaty structure for the ceding insurer. B. To assess and determine the payment of claims covered under the reinsurance contract. C. To evaluate the ceding insurer's underwriting guidelines. D. To negotiate the premium rates for reinsurance agreements. Answer B. To assess and determine the payment of claims covered under the reinsurance contract. Explanation. The claims manager's main responsibility in a reinsurance company is to assess and determine the payment of claims under the reinsurance contract. This includes verifying that claims are valid, processing payments, and ensuring compliance with treaty terms. Answer A refers to the underwriting process, not claims management. Answer C pertains to underwriting guidelines, and answer D is related to pricing negotiations, not claims assessment. Question 25. Reinsurance types. Which of the following best describes an excess of loss reinsurance arrangement? A. The reinsurer assumes a fixed percentage of losses on all policies in the ceding insurer's portfolio. B. The reinsurer covers losses that exceed certain threshold after the ceding insurer has paid up to specified amount. C. The reinsurer assumes full responsibility for all claims related to specific policy. D. The reinsurer only covers claims related to specific types of risks or geographic regions. Answer B. The reinsurer covers losses that exceed a certain threshold after the ceding insurer has paid up to a specified amount. Explanation: excessive loss reinsurance provides coverage to the ceding insurer for losses that exceed a certain threshold known as the retention level. The ceding insurer is responsible for claims up to that threshold, and the reinsurer covers any excess. This is a form of non-proportional reinsurance, which contrasts quota share reinsurance. Option C describes facultative reinsurance, and D describes a geographic limitation, which is not inherent to excessive loss reinsurance. Question 26. Financial aspects. When evaluating a reinsurer's financial stability, which of the following metrics is most commonly used? A. The reinsurer's net income for the previous year. B. The reinsurer's claims payout ratio. C. The reinsurer's solvency ratio. D. The reinsurer's market share in the industry. Answer: C. The reinsurer's solvency ratio. Explanation: the solvency ratio is a key metric used to assess reinsurer's ability to meet its long-term obligations, including paying out claims. It is a measure of financial strength and stability, while net income, A, claims payout ratio, B, and market share, D, provide useful information. They are not as directly indicative of reinsurer's ability to remain solvent in the face of large claims. Question 27. Risk management. Which of the following is an example of a reinsurance arrangement used to manage catastrophic risk? A. Treaty reinsurance. B. Quota share reinsurance. C. Excessive loss reinsurance. D. Facultative reinsurance. Answer: C. Excessive loss reinsurance. Explanation: excessive loss reinsurance is specifically designed to protect insurers from large catastrophic losses, such as those caused by natural disasters. It covers losses that exceed a specified threshold, thus helping the insurer manage their exposure to catastrophic events. Treaty reinsurance, A, and quota share reinsurance, B, are more common for day-to-day underwriting risk, while facultative reinsurance, D, is for specific individual risks. Question 28. Reinsurance basics. Which of the following best describes the term retrocession? A. The act of a reinsurer passing part of its reinsurance risk to another reinsurer. B. The process by which the ceding insurer selects specific risks for reinsurance. C. The agreement between two reinsurers to share in the underwriting of risks. D. The process of increasing the retention level for an insurance policy. Answer: A. The act of a reinsurer passing part of its reinsurance risk to another reinsurer. Explanation: retrocession refers to the transfer of reinsurance risk from one reinsurer, the retrocedent, to another reinsurer, the retrocessionaire. This is similar to how reinsurance works between insurers, but it involves the reinsurer rather than the ceding insurer. The other answers refer to different concepts within the reinsurance process, but are accurate descriptions of retrocession. Question 29. Legal and regulatory framework. Which of the following statements is true regarding New Jersey's reinsurance laws? A. Reinsurers are allowed to engage in unlimited retrocession without regulatory oversight. B. Reinsurers must maintain reserves in accordance with the New Jersey Insurance Code to cover potential claims. C. Reinsurers in New Jersey are not required to submit financial statements to the Department of Insurance. D. Reinsurers can freely enter into reinsurance agreements with any insurer regardless of state regulations. Answer: B. Reinsurers must maintain reserves in accordance with the New Jersey Insurance Code to cover potential claims. Explanation: under New Jersey's reinsurance regulations, reinsurers must maintain adequate reserves to cover potential claims. This ensures that the reinsurer is financially able to meet its obligations. Retrocession, A, and entering into reinsurance agreements freely, D, are not allowed without compliance with state regulations. Additionally, reinsurers must submit financial statements, C, to provide transparency and regulatory oversight. Question 30. Claims management. Which of the following best describes the role of the reinsurance claims examiner? A. To determine the coverage limits for each individual reinsurance policy. B. To oversee the claims settlement process and ensure it complies with the terms of the reinsurance contract. C. To negotiate the reinsurance premium rates with ceding insurers. D. To determine the appropriate reinsurance structure for each individual risk. Answer: B. To oversee the claims settlement process and ensure it complies with the terms of the reinsurance contract. Explanation: the reinsurance claims examiner is responsible for overseeing the claims settlement process to ensure it aligns with the terms of the reinsurance contract. This involves verifying that claims are valid and ensuring proper payment of reinsurance claims. The other roles mentioned are typically handled by other departments, underwriting A, D, or pricing C.